And this is my thesis of the exponential age, is we're about to go through a period of exponential change, the fast adoption of technology of all human history, which is AI, robotics, space, EV, Internet of Things, distributed computing, genetic sciences, longevity sciences. All of these things are all happening at the same time and all linked to each other, blockchain technology. It gives us a potential to generate productivity growth. So that's at a big picture level. So we need 10, 15 years for the technology to start driving productivity, for the baby boomers to die off partially, and for us to run negative real rates so the debt burden's okay. That's what I think the big picture is. Where inflation remains within that picture, does it go back down to lows? Does it get sticky? At a big picture level, doesn't really matter, because it certainly won't remain high because the economy can't take it. It's a net tightening of financial conditions in itself.
Stocks slumped and short-term U.S. Treasury yields hit 15-year highs after the Federal Reserve delivered another mega rate hike as expected, but also signaled it would have to take rates higher than it originally planned, even if at a slower pace. Markets were disappointed again as the dollar's signal they were hoping for failed to materialize, snuffing out an equity bounce. We see the Fed on a path to over-tighten policy and don't expect it to pause until the damage caused is clearer. Tech stocks suffered as the fallout from a largely disappointing earnings season for bellwethers such as Facebook parent Meta Platforms, Amazon.com, and Microsoft continued. Late in the week, Amazon.com announced that it was pausing its corporate workforce hiring, further dampening sentiment. Although it is now a private company, the deep job cuts expected at Twitter under new owner Elon Musk added to the malaise of the tech sector. Markets will keenly watch the US CPI for any signs of easing inflation. Persistently high inflation could embolden the Fed to hike rates even more than the market expects. Consumer sentiment may give a sense of the economic damage inflicted by the Fed's tightening, and the report will also show the latest snapshot of household inflation expectations. Raoul Pal, the co-founder and CEO of Real Vision, in a new interview has shared his views on where he believes we are in the current market cycle. He shared a lot of important insights that helps to explain what is currently going on and what we should also expect in the near future. This is one interview you cannot afford to miss. Thanks so much for watching our videos. Don't forget to smash the like button.
So that's what I think is going on at big picture level. And then to shrink down to where we are today, well, we've got the tightest real rates you can imagine, considering the amount of debt burden, if you adjust it for debt. You've got, net tightening of financial conditions caused by commodity prices, the dollar, everything else. So the probability and the forward-looking forecasts are that GDP growth will fall significantly and inflation fall significantly. Where does inflation end up? None of us know yet, and we can debate that all day. We just don't know, but the probability is that inflation falls. So then let's go down to the issue that's at hand, which is today's story because of the Fed. What are the Fed about to do? Now the Fed know that the economic growth data is falling apart going forwards. Everybody knows it. The question is how do they stop inflation expectations rebounding when markets rebound? Because they will. The moment they pivot, markets will rebound. That's okay, but they can't drive expectations of inflation driving, because inflation is not the stock market. But it's all partly tied in. The oil market's obviously a big equation in this. My guess is the Fed will start to slow down the rate of change of increases. And all that matters in financial markets is rate of change. The markets pick this up. I think the crypto market picks it up first. Long end of technology and a few other things have started to pick it up as well. So the rate of change changes. And then the next part is something to do with either changing the regulations, forcing the banks into the reverse repo via Basel III. And Yellen's already talked about, they're talking to the regulators to see what they can change. If not, it's the Treasury buybacks or increasing some liquidity into the Treasury market, which has become much less liquid than it usually was and is creating a problem. Then after that is, I think, the Fed pivot once inflation falls below Fed funds. Now, where's terminal Fed funds? I don't know. I'm guessing somewhere between 4 and 4.5. So when does inflation get below that? Every forward-looking indicator I've got from inflation looks like it falls through Fed funds by about March, April. So that's the sequencing of events. I think we're at the turning point. If I look at the forward-looking indicators that I use, like my financial conditions index and a whole bunch of other stuff, Chinese credit conditions, they're all signifying that the bottom of the cycle is probably in Q1. So, okay, so the bottom of the cycle, we've got the worst part to come still. We've got the ISM to get from here down to 40, but the bottom of the cycle comes in Q1 and the markets are start to forward look. So that's kind of where I think we are. I think we're at the turning point, and a significant turning point. And I'm not talking about today or tomorrow. I'm talking about the next 4 weeks to the next 6 weeks. So reasonably short-term time horizon. So it's coming down. I've got a lot of technical signals that say the same thing, whether it's tops in the dollar, and that would be probably a temporary top. The potential lows in the equity market, potential highs in the bond yields, and we had a lot of signals in lows in the crypto market. So that's it in one go. There's two big things, I think, is when we step back, people hear me talk a lot about debt, demographics, all of these things, but what it is, and I kind of distilled my thinking down, is what is GDP? GDP, essentially GDP growth over time, not quarter by quarter, is driven by demographics, i.e. population growth, plus productivity. That's the kind of magic formula. Once you understand that, you can build a framework around it. And the framework of understanding is, as I've been talking about, demographics is a net draw. And I know there's some arguments out there from others that maybe the capital gets released by the baby boomers and it could be inflationary. There's no evidence of that anywhere in the world yet. So, that's a risk to the view, and that's fine. So demographics is a real problem for the Western world plus China, plus Southeast Asia. Aging populations mean GDP growth goes down. What we've seen is because of globalization, technology, and too many people in the workforce at the same age, the baby boomers, they've competed for wages, and real wage growth has been flat for 40 years. So i.e. the average American has had zero increase in wages. And the second drive why that's occurring is obviously the competition at wage level, i.e. 76 million boomers competing with each other and now competing with their kids. They're both in the labour force at the same time, competing with AI, robots, the internet and everything else, competing with Chinese workers and Indian workers. I mean, that's a pretty difficult environment for everybody. Nobody really wants to increase immigration. So Alf, you're in Italy. Italy had a huge immigration and everybody wants to slow it down because it's hard to digest at societal level. The UK had the same, Germany's had the same, Denmark's had the same, Sweden's had the same, everyone's had the same. So population immigration, not that these populations are particularly against immigration, but there's a limit to the number of people you can accept at any one time without society breaking, because what happens is there's too much competition for jobs again. So you lower the real wages of the population.
Year-over-year inflation in the Eurozone accelerated by more than expected to 10.7% in October from 9.9% the previous month, fueled by higher energy prices. Food and imported industrial goods prices also rose sharply. The core rate, which excludes volatile food and energy prices, increased to 6.4% from 6%. Meanwhile, an early estimate showed gross domestic product growth expanded 0.2% in the third quarter, a slowdown from the 0.8% growth rate recorded in the April through June period. What did you make of Raoul Pal's interview? Please share your thought with us in the comment section. Thanks for watching.